Hey traders, this is Blake Morrow with Forex Analytics, and you're listening to the week ahead video for August 7th, 2022. For those of you that are out on holiday, I'm going to say, good for you. I'm jealous, and you're missing a lot of volatility. We have seen some volatility in this market, even though it's a holiday season, and we've got a lot of Europeans traveling around, a lot of people in the U.S. too. I don't reference so much in the U.S. just because my kids already went back to school. But a lot of people are on vacation, are on holiday, but the markets are still moving. So if you're sticking around, you're watching these videos, if you like them, make sure you give us a thumbs up, subscribe to the channel down below, and share this video on social media. If you saw us on Twitter or on LinkedIn or wherever you Facebook, just pause this video, share it, like it. We'd appreciate it. I know the team that works around the weekend would really enjoy it as well and really appreciate it. All right. Thank you very much. Let's get on to the market. So we are probably coming into one of the most important data points of the month of August. We just got past the jobs report. We'll talk about that here in a second. But we have the CPI, US CPI coming out on Wednesday. And let me just say, first of all, let's get over to Forex Analytics here, and I'll take you over to the calendar. If you guys want to follow along, on your app, you can do that right here. But I just wanted to say that we have a very similar issue this next week that we had last week. If you remember the conversation about last week around the non-farm payroll numbers, if the data came out strong, the stock market was going to come under pressure. The reason why is because people would think that the Fed might not be so willing to to be more dovish and less likely to continue to raise interest rates if the economy is starting to slow. But as you can see, the employment picture last week when we created over 500,000 jobs here in the US, the stock market actually came under pressure. Good news is not good for stocks. All right. So if it's bad news or a weak piece of data, that's usually good for stocks because people would feel that the Fed might, taper back on their hawkish rhetoric and might even not raise rates so aggressively. Now, the real key data, like I said, is going to be the employment or the inflation data. Everybody's really looking at inflation. Last week, if you don't remember when we were talking about employment, I thought it was a little early to start betting against employers at this point. I think that there's still a lot of money sloshing around the system, and employers are still adding employees. They just might not be adding them as quick of a rate as previous. But I'll tell you the amount of jobs that were created was well beyond my expectations on Friday. But I do want to say that that one of my colleagues, Stelios Kontogulis, he talked about last week about consumer credit, and this is an interesting chart from the Trading Economics site where you can see consumer credit is going higher, and so that means people are accessing their credit cards probably because inflationary pressures are strong, and they're searching for different ways to be able to pay for things. That is something that we do have to pay attention to, as we move forward, because I think that this is one of those pieces of data that is suggesting that we might be in for, a much harder recession, as people have a harder time paying down their credit card debt when, this revolving credit rates continue to go up. So that's one thing that you gotta pay pretty close attention to as we move along. But going back to the inflation data. Has inflation peaked? I don't know, but I do know this that the market is looking for some weakness to start to seep in as far as inflation goes. Now, if that's the case, that's going to support stocks. But I'm going to go back and I'm going to if you want to go back and look at our analysis, you can always go back here on the Forex Analytics platform, although our analysis is being updated throughout the weekend, as you all know. But we keep our week's worth of data here, our analysis, then we delete it and go on to the next week, or you just continue to scroll because we update these charts throughout the week, sometimes multiple times, depending on what type of analysis you happen to be looking at. But I'm going to take you over to some live charts, and I want to talk about what we had discussed last week. So last week, if you recall, we talked about the stock market continuing to rally at the beginning of the week and then finding some resistance higher. Now, what I was thinking, if you go back to last week's week ahead video, was that we were going to probe a little bit higher, just above 4,200. And then if you remember, just go back to last week's, or you might even recall, I drew something that looked like this and look for a reversal. I'm like, well, you know, we might be able to pop above that resistance and then reverse, head back in the bearish trend, in the bear market that we have, and the bearish trend that we've established in the S&P this whole year. That didn't quite happen. We did get the rally at the beginning of the week, and then we saw a reversal because of the strong jobs report. Stocks came down. Now they did recover towards the end of the day, but you can see we basically started to struggle here towards the end of the week. So what is the problem, and why do I bring this up? Well, I'm going to have to take a look at a couple other indices, so make sure you stick around because I'm going to talk about what's happening in the Nasdaq and what's happening in the Dow as well. But the problem that you see here is that a bearish trend is identified by lower highs and lower lows. We failed thus far to take out this previous high, and so we still have, you could say that's an equal high, but I actually say it's still a lower high. Regardless, we are continuing to hold that resistance that is really close to that 4180 level, 4200, somewhere around there. Can we take that out? Sure we can, absolutely, especially if inflation does indeed show some weakness. If the inflationary print shows a little bit of weakness this week, you bet, the S&P would probably scream higher, and then we might actually get what we talked about last week, where we get a push up above 4,200 and maybe probe into some resistance and maybe even channel resistance. I'm going to take you over to the daily chart here. The 200-day moving average is not that far away. It's only about 150 S&P points. And, short squeezes in a bear market are fast, aggressive. They hurt a lot of people. There's a lot of people are trying to lean in short to this market. They have been. And they've consistently gotten run over the last few weeks. You can see the S&P continues to just power higher. So I'm not going to disregard the idea at this point that we can't stretch out to the 200-day moving average. I think it's entirely possible that we do that. Now that really is going to be dependent on if we get weak inflation data, then we're going to push back up towards that 200-day moving average, towards that channel resistance. But if that data continues to come in strong, then this bear trend and this bear market will just continue to take hold, and we're going to probably slump back below 4,000. But it all really relies on Wednesday's data coming out in the U.S. So just keep that in mind. But I want to take you over to the Nasdaq because the Nasdaq's actually probing some pretty key resistance here. Channel resistance in the Nasdaq. We did make a higher high. Now that's important to note, but the problem that I see with the Nasdaq is that we're stalling around the 38% retracement, which, if you're a Fibonacci guy like I am, you're a Fibonacci person. You love to study fibs. Well, when something stays below or around a 38% retracement, and then we start to see a continuation of that trend, that typically means that we're going to get a continuation of that trend, and it's going to be strong. So whenever we get a 38% retracement, the likelihood of us, retesting these lows is heightened. It's not a given, but it is heightened because it's a shallow bounce, and a shallow bounce usually leaves us with a continuation in this case, a bearish trend. So we're going to be watching the Nasdaq because not only are we at the 38% retracement, this is the Nasdaq 100, by the way, not the composite, but we're also at channel resistance. But take a look at the Dow. The Dow's also got a similar issue. The Dow is not making higher highs. One of the things, if you remember, you'd probably have to go back, a month and a half, 2 months ago, when we talked about the Dow being at really important support. I even remember taking the screenshot, and if you were watching us on YouTube, you got the screenshot with a big arrow. Whoops, a big arrow that looked like this. Big arrow that looked like this, or something like that, that was pointing at the 38% retracement because we were testing really key support. And guess what? The stock market bounced like a bat out of hell. The Dow did. And that was one of the conditions that I was looking for a couple of months back to start playing risk on, being long the Aussie dollars, trading Mexican pesos long, trading risk long. Go back, like I said, a couple of months ago, you'll see that. But here's the problem that I see with the Dow. We're still not making new highs, not yet anyway. And then if you actually take the all-time high in the Dow and then all the way back down towards that 38% retracement that we were at before, you'll notice, and let me go ahead and zoom back in here. What you'll notice is the 50% retracement comes in right around those highs. And also, by the time we get there, this descending trend line, some people might draw it like this and forget that wick right there. Some people might draw it like this, but it's going to be interesting because we're going to be coming up towards a descending trend line in the Dow. So I think it's really important that you not only pay attention to what's happening in the S&P, but you look at other indices as well, because everything's going to be driven by Wednesday's data. I know a lot of you are intraday traders. If you are, hey, tread lightly for the next couple of days. And on Wednesday, make sure you're in front of your computer on the Face show that's free of us broadcasting and going through it live on the day of. So if you don't know how to get there, all you have to do is go to our website, forexanalytics.com, to get to this free show. There's two free shows that we have. We have the Flow Show, which typically is hosted by Ryan Littlestone and K-Man, but they're both happen to be out on holiday in the UK this last week. K-Man comes back this next week, and it's hosted by Steve and Stelios right now. Then you have the Face Show that you'll catch me on and the rest of the team on there in North American Trade. It is free to register, so go ahead and register for those when you get a chance. All right, let's go back to the markets and let's talk about what could happen in currencies, because the currency market, it's different than when we were talking about equities. Equities is good data or strong data is bad for stocks. Weak data is good for stocks. But in the dollar's case, good or strong data is strong for the dollar, and weak data is weak for the dollar. It's going to suggest a weaker dollar. So, it's pretty cut and dry as far as data goes when you're dealing with the dollar index. Now, let's go take a look at the dollar index and show that very important support that ended up holding that we were talking about last week. That support held around the 105 level. And if that continues to hold, we have to continue to respect the upside bullish trend that you see here in the dollar index. Now, you may be a dollar bear, and that's fine. If you are a dollar bear and you think the euro is going back to 108 and the sterling is going to see 125, whatever the case may be, if that's the case, that's fine. Be a dollar bear, but just realize that while it's above 105, it's going to be very difficult to be a dollar bear. All right. We are holding now. If you look at the most recent, down move, we are holding the 38% retracement. And my assumption would be any move in the dollar back up towards this 107 level is probably going to struggle. And if you really want to be a dollar bear, maybe you look for a euro dollar dip down to the parity level, or maybe down towards 101.50 for a long. If you really want to be a dollar bear, right? You look for, a euro dip to buy into. Now, me personally, I struggle to see the reasons to be a euro bull. And that doesn't make me right, and that definitely doesn't make me wrong, but I struggle with understanding what makes the euro bullish right now. I was talking to a couple FX traders this last week, interviewing with them, and one gentleman, he was like, well, the fact of the matter is the euro is holding up around parity. The buyers seem to emerge down there, and for whatever reason they are there. It's true. I mean, whenever the euro dips down to parity, it's a big psychological level. There's probably a ton of option activity. And by the way, if you want to know where all the option activity is, just go to Forex Analytics, go into where it says market info, go to orders and options, and you can see some of the biggest expiries and where they're happening, because they tend to attract price. I'm sure there's a lot of option expiries that are hovering around that parity level. So you got to be respectful of that, especially if you're in the camp that you think that the euro is going to eventually drop towards 90 cents. Which I wouldn't be surprised if it does. But you have to imagine there's been a lot thrown at the euro, whether it's a Russian invasion of Ukraine, whether it's an ECB that can't seem to get their head out of their butt and start raising rates aggressively to fight inflation. We all know the reasons why they really struggle to do that. If it's not, not the energy crisis that, a lot of Europe is going to be facing going into the fall. There's a lot of reasons why the euro should be lower, but let's all understand that it's not. And a lot of that probably has to do with interest rate expectations, as interest rate expectations for the Fed have moved up so aggressively higher. A lot of people wonder if those are going to continue to go up, but that is probably going to be answered. That question will be answered with the inflation data that comes out on Wednesday. Remember, strong inflation data, the Fed's going to continue to raise rates higher. Markets are going to continue to expect that the Fed stays hawkish and they continue to raise rates at a very rapid pace, and that could be what sets the euro off down towards parity once again. Now, before I get into the sterling, because we do have GDP data coming out of the UK, and we're going to talk a little bit about last week's price action in the UK. I need to mention this. If you guys haven't tried out Forex Analytics, make sure you do so. It's only $1 for 10 days to try it out. Download the mobile app, because you get the mobile app no matter what version of Forex Analytics you want, whether it's the premium or the light version, which is only $20 a month, which allows you access to all of our training that we do all week long, even exclusively for the Forex Analytics subscribers. So make sure you try it. And then also, hey, if you want to trade our money, you don't want to trade your own money, you don't want to risk your own money, or you just want the ability to access larger amounts of money, check out the Trader Funding Program. What separates us from everybody else is simply this. Two things. We offer a massive amount of support. You get to jump in the Forex Analytics community and have ideas and have support and be able to hear myself and the rest of the team talk about what we're looking to buy, what we're looking to sell, and why. You get that support, and there's no time limit. We don't pressure you to pass your assessment so you can access our funds. Take your time. Trade small. Get comfortable. Take as much time as you need. As long as you're executing one small itty-bitty trade once every 30 days just to keep your account active, take as much time as you need. So check out the Trader Funding Program if you haven't done so already. There's a 2-minute video at the very bottom that will explain a lot more about what I'm talking about. All right, let's get back into the charts and let's get back into the markets, and let's talk about the sterling. And I'm gonna actually take you into a couple last charts that I want to discuss. I want to talk about the sterling, and I want to talk about the Aussie. The Aussie, which we don't have any Australian data coming out, but I want to make sure you guys stick around to watch both of this, the analysis on both those pairs. So let's start off with the sterling. So the cable and the sterling, the pound, whatever you want to call the pound dollar, it broke lower out of this channel. The important thing that you have to realize about the pound dollar is that we rejected this 618 retracement. You could argue that there is some sort of base building here. You could say, well, Blake, I see a really big base developing. Whether it's going to end up being like a head and shoulder pattern, coming up, or it's just a big, rounded bottom. There is, you can see clearly there is a base starting to develop with the pound. There's a lot of, it seems like it's more UK people than anybody, and that maybe because you all that live in the UK are boots on the ground, and you do, and I don't. But it seems like there are so many UK people, citizens, and traders that are extremely bearish to the sterling. Whether it's Brexit, whether it's high inflation, whether it's Andrew Bailey as a schmuck, whether, you name it, you can throw your, whatever you want at the pound. There are a lot of bears out there, but you got to respect price, right? So, As long as we continue to hold around this 118 level, I mean, I'm a little reluctant to be super bearish the sterling. But technically, we broke down on this channel. We held the 618 retracement, and that is something that if you are a bull, you have to be respectful of. That we could see below 119 and maybe even closer to 118. But we have UK GDP data that's coming out, and a lot of people are forecasting a really hard recession going into the end of this year in the UK. So obviously everybody's going to be watching that. That is going to be 11 p.m. my time, Thursday, which that means it's way early in the morning. Way early in the morning if you live in New York, and obviously it's going to be Friday morning in European trade. So just keep that in mind. That's some data that we're all going to be paying attention to. Oh crap! I just realized there's actually two other things I want to talk about. So there's the pound, and and above the 123 level, I think this is where you have to start thinking, okay, maybe there's something to this this bull argument in the sterling. That's all I wanted to say about the pound. All right, next I want to talk about the Aussie. Let's talk about the Aussie dollar. Now, the Aussie is very similar to the sterling, but I want you guys to take a look at this long-term descending channel. You guys know I've been very, very respectful of this channel. I continue to buy dips while we're above, or especially dips below 68 cents, while we're above 67 cents. I want to be a buyer. I do think this is a long-term inverted head and shoulder pattern. That doesn't mean we can't drop to a lower low and still have an inverted head and shoulder pattern. That can happen. I'd like to believe that this low is going to hold, but I think it has more to do with what's happening with stocks than what's happening in the Aussie. As the RBA continues to raise rates, but one of the reasons why, and they try to keep up same pace as the U.S., but one of the reasons why, well, to a certain extent, anyway, one of the reasons why the Aussie continues to trade heavy is because stocks aren't, they're not really moving higher either. I mean, yeah, we've had a nice bounce, but guess what? So is the Aussie. The Aussie went from 67 cents basically to 60 or to 70 cents. So we're coming off again as stocks might weaken a little bit here too. But what I'm going to be looking for going into this next week is I am going to be looking for these levels somewhere right around that 68 cent level to see if it does hold. And if it can continue to hold there, excuse me. You're probably going to see me start to pick up some long positions in the Aussie. One last thing I wanted to talk about today is I want to talk about the US dollar Mexican peso. Now, the dollar mex has been all over the place, but I'm going to go ahead and draw this out for you. Here's the ascending trend line that I am paying attention to in the dollar mex. But why am I paying attention to the dollar mex this next week? A few reasons. Number one reason is that we have interest rate decisions out of Mexico. So so Banxico is expected to, let me take a look. Let me make sure I got the correct numbers. They are expected to raise rates from 7.75%, another 0.75% to 8.5%. They are indeed trying to stay and keep up the interest rate differential between the U.S. Federal Reserve and Banxico. So they are expected to raise rates 75 basis points. But also, Mexican inflation rate comes in Tuesday morning, very early in the morning. So when that comes out, that could really move the market. Now, inflation data out of Mexico is coming out on Tuesday. Inflation data out of the U.S. is coming out on Wednesday. So that's going to provide some opportunities. You could get a jerky type of reaction here where you get a move up in the dollar mex and down, or you get the opposite, maybe a move down with stronger Mexican inflation data, and then a move back up if U.S. data misses, things like that. So just keep in mind that this is the dollar mex. We're around some pretty key support, couple key levels are watching now, or a couple key levels we are watching, and couple key data points. The one other thing that I want you all to pay attention to is that, and this is where the monkey wrench gets thrown into the market, is the U.S. dollar Mexican peso is very risk sensitive. So if, let's say, the U.S. data, and I'm just gonna blurt it out there, and then we're gonna draw it out, and just imagine what I say does happen. So let's say on Tuesday, we have strong inflationary data out of dollar mex. out of Mexico. Sorry. So out of Mexico pushes the Mexican peso down a little. It's strong inflation. Did I say strong? I meant strong inflation data out of Mexico. The Mexican peso firms up. Dollar Mex drops a little bit. Maybe even breaks through the support. Okay. I'm plotting this out for you guys. So hopefully you are appreciating it. And if you are appreciating this right now, make sure you give us a thumbs up. Smash that like button, as they like to say in YouTube land or Ville. Okay. So Mexican inflation data surprises to the upside. Mexican peso firms a little bit. Dollar Mex drops. Great. Now comes Wednesday. Wednesday, inflation data in the U.S. misses expectations. Now, if the U.S. data misses, or if U.S. misses inflation data expectations, what happens to the dollar? The dollar goes down, right? But what happens to stocks? If inflation data is weak, that means the Fed is less likely to hike rates aggressively. If that happens, stocks go, which is in orange, they go up. And if that happens, the Mexican peso will outpace other currencies because emerging market currencies tend to be bought more aggressively when stocks go up. So we might see a more aggressive move down in the dollar Mex. So, guys, if that didn't make any sense to you, don't worry. Come join us at the free Face Show, where myself and other team members, we will be talking about those specifics on how that macro data, how that fundamental data will move the markets. It's free. Why not? All right, guys and gals, I want to say thank you so much for attending today. Thank you for spending your last 20 some odd minutes with me. I do appreciate it. I appreciate the support, and so does the Forex Analytics team. So have a great remainder of your weekend, and I'll see you Monday morning on the Face Show. Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.